Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young and today is July 20th, 2023. Today we're going to ask the question, is the housing market on shaky ground? We saw some key economic data reported today, and more than that, we've had some earnings come out that have made a little bit of shakiness in equities. Equities have pulled back today. We saw the Nasdaq reach about 1.75% correction at the low point and has recovered a little bit off those lows. You can see the SPY is a gap down, closed down as far as this chart is currently, but it's certainly not the end of this move necessarily. It's just showing some maybe a pullback and temporary weakness near the top. But when it comes to housing, we're getting a little bit of a different story, and we'll come back and look at the major equities here in a moment. So let's go take a look at the data that was reported today. Starting with housing starts and building permits, you can see housing starts and building permits both missed expectations. We're lower than the previous month as well. So we're not only seeing a slowdown, but we're also seeing missed expectations. Same thing with existing home sales. Existing home sales went from 4.3 to 4.2 to 4.1. But let's break these down really quickly into what this means as far as the real estate sector or markets. Housing starts are buildings that began construction. Building permits are getting the permits to build the building. So generally speaking, if there's less building permits, there are going to be less housing starts in the next month. If there's less building permits and less housing starts, then you're going to get less new home sales, which we'll look at here in a moment. If there's less new home sales, then generally speaking, the demand for existing home sales will fall down as well. So if I scroll up here, and the only reason why I have to do this is because there's too much data in this chart. But the new home sales, you'd expect that one to slide if there's less homes built. But we're going to dig a little bit deeper into this. So again, it's this chain. We have to get the permits. After you get the permits, you have to start the homes. After you get the homes started, you have to complete the homes to sell a new home. And if new homes are the higher demand, great. But the more new homes that are being sold, generally speaking, then the more new homes are on the market, the more new homes that are available, and therefore existing homes will also increase as well. So if we look back to last month, you can see new home sales were at 763,000. That means we're clearing out the inventory of those new home sales, and these are the ones under contract pending home sales. So we saw clearing out the inventory on new home sales. We'll come back to home price index in a minute, but we cleared out a bunch of the inventory in new home sales in June. Pending home sales faded. So the number of homes under contract that hadn't sold slowed down dramatically. The new homes cleared out a bunch of inventory, and we'll get to the reason why we think this is all setting up down here, is we can see that the housing starts, building permits, and existing home sales all fell lower, and fell lower dramatically. If we look at the key data here, we click on home starts and look at the charts, you can see it from last month to this month, that was a significant drop. If we add in the revisions, you can see that there's revisions up and down, up and down, up and down, but most of those have been less than what was reported. So we're reporting, hey, there were new homes started, and then we say, well, maybe not, maybe not, maybe not, maybe not. So all of these have been revised lower. Last month, it was telling us that we had 1.63 million new homes started under construction. Well, reality was there's only 1.56, so there's 80,000 new homes that didn't get started when we thought they were. They're revised lower. And then this month, we were expecting to see that 1.48, and we only came in at 1.43. So if we revise this lower similarly, we could see just in the last 2 months, 100,000 new homes that didn't get started. That's a major indication that we're not moving forward. The contractors are not building or building as quickly as what we once thought. That's still not enough to really track down what we're looking for. The problem is that existing home sales are sliding, and in reality, those existing home sales have been sliding for months. So if we look back here, we had a peak in existing home sales in February of 2022. Since then, we've had lower existing home sales. That means the people that already have the homes are not interested in selling their homes. New homes can still be built, new homes can still be sold, but existing homes show that we are not moving from one home to the next. It doesn't matter if we add new homes. If we're raising rates, does anyone want to sell their existing home, even if prices are high? Does anyone want to sell their existing home to get a new mortgage at 6% if they have their existing mortgage at 3%? So I don't expect existing home sales to suddenly turn back up to fulfill demand if we keep raising rates. If we add new homes in construction, the people that have their homes are not willing to change out a 3% mortgage rate for a 7% mortgage rate to get into a new home. They're just not seeing that as a valuable thing. And if they're going to sell their existing home and buy a different home or a new home, they need to add into or calculate the increased cost of the higher interest rate. So that's decline in new home sales, just so you can see that this is the lowest or approaching the lowest it's been other than in 2020. So during the lockdown, this is the lowest level of existing home sales going all the way back 23 years, excluding the 1 month here in 2020's lockdown. So major slowdown in existing home sales. But the fact is, if interest rates are going to remain high, existing home owners, existing mortgage holders are not interested in selling their homes and getting a higher mortgage rate. Now, as we're watching that, we're looking at the moves that are going on in existing home sales. Let's go back and talk about prices, because you might say, well, why don't we sell existing homes at higher prices as they're near their peak? The market has just stopped moving. 1% of U.S. homes have changed hands in 2023. It's the lowest ever on record in the history of the United States as far as the percentage of homes that changed hands. Less than 1% of all homes have changed hands in 2023. That's the lowest level. You'd think that at these higher prices, we would want that high ticket sell of the home. Well, home prices are generally, you can consider them the number one indication or number one source of wealth for consumers. So if we go up and look at the home price index, we have an HPI and an S&P Case-Shiller's composite home price index. So these are two different numbers. The one is from Case-Shiller's home price index, and the other one is from Fannie Mae and Freddie Mac. So you can see right here, HPI, change in purchase price homes with mortgages backed by Fannie Mae and Freddie Mac, so it's direct reports from the government. And the Case-Shiller home price index is trying to track down home prices and is looking at a kind of a longer time frame, but specific in 20 key metropolitan areas. These are supposed to be the stronger housing markets. So one's reported everywhere, Freddie and Fannie, or key 20 metropolitan areas. A little bit different story. So Freddie and Fannie government-backed loans saw higher prices. Why? Because they're government-backed. Think of the lower cost or the supplemented, subsidized Freddie and Fannie loans qualifying people that are not going to qualify for traditional conventional loans, possibly. And the prices are going to go higher because that's what always happens when you subsidize any type of borrowing. Anytime you subsidize anything at all, the prices go up. Well, we look at the Case-Shiller home price index in the key metropolitan areas, and those prices went down. In fact, if we look at the ones that are saying this is the standard loan, this is the standard wealth factor in the United States, look at this chart. We dropped further from the peak, 21.2% in May of 22, all the way down, crossing negative in May. And this is the first time we've been negative on home price index. Prices are falling, collapsing, slowed their growth, falling aggressively. And watch what happens when we add the revisions. We add the revisions and we say, oh, prices were actually lower here and lower here than what we thought. And we're projecting that it was being lower. So we say, oh, it's a good number. It's negative 1.7, higher than what we expected. But is it really a good number? If we look back at the chart and go all the way back here, the last time we were negative was in 2010, and we had negative home price indexes through 2011 to 2012, and the only other time prior to that is the real estate crisis. So now that we've pushed negative, we've only had two different times that we've had home prices drop in value. As we look back here, we could track the economy and the pullback through here almost in lockstep with equities. Even this pullback that we had in 2011 and 2012. We've gone negative for the first time since then, and this negative view tells us that we as consumers, if you still have your traditional mortgage, if you're in a standard market, you do not have access to as much capital from being able to borrow. And people aren't borrowing because we're not borrowing at these higher interest rates. So this negative move in the Case-Shiller Home Price Index is telling us that we are now seeing less wealth accessible by the consumer, and maybe because we've already spent it. And we're seeing lower prices, negative prices, while we're also seeing a slowdown. So generally speaking, if prices are dropping, we should see an increase in demand for existing home sales and building or new homes. We're not. Everything is slowing down. We're seeing it drop by 2%, 3% month over month. And our housing starts, our building permits, our existing home sales, and our prices are all dropping together. Now, obviously, the big catalyst here is interest rates. We know that we're going to be looking at a rate hike next week. According to the Fed Watch tool, we're at a 99.8% for next week's. And if we go out to September, jump it down here. So you can see yesterday we were at 13% of a second rate hike. We're now at 18%. So despite the market correction, despite the pullback, despite the complete miss in new home sales and new construction and building permits, we're seeing an additional rate hike being priced in. So we're seeing that move higher. In fact, by the end of the year, earlier, we were seeing that we were pricing in a rate cut by December. If we look out to December, expecting a 99% probability that we're going to be at this 5.25 and 5.5, if we go out to December, we only have 11% probability of a rate cut and actually a second rate hike of 26. Really, I'd say we have a very high probability we're just going to stay at 5.25 and 5.5 according to the CME report. Point being is, if this is what's happening with mortgage rates. Now, I use the TNX to determine this. You can see the TNX had this massive consolidation. We broke out in June, rose up to retest the horizontal resistance area, fell back and found support at what was our previous trend resistance, and we've bounced off there today. So this bounce up at 3.85%, generally speaking, if you're looking at this as a mortgage rate and you're looking at this as a price pattern, what would be the price pattern target? We're going to add 2% to the current price to get an estimate of what mortgage rates are. We saw the breakout and a retest, so even if we just go off the breakout, theoretically, the mortgage rates could go to 4.4 plus 2%. We'll call it 4.5 plus 2%. So we're going to see the A paper rates get to about 6.5% mortgage rates. What does that look like in conjunction to the long term? That will be the highest rate we've had in 3 years. It will be the highest rate we've had going all the way back to the real estate crisis. So we're going to push interest rates and mortgage rates to the point where they are seeing the same level in 2007, 2008. The last time we had housing go negative with this high of a rate. In 2011, 2012, you can see that the treasury rates were falling, even though housing demand was falling. So that would have been the reason why we based out and didn't go any lower. But if we're raising rates this time, while we go into that negative home price index, we are setting up for a bigger correction. To look for the stocks that are in those areas that are going to benefit or be hurt from that, then we're going to go and look at the ones in the different areas of the real estate market. So there's specialty REITs, there's residential REITs, commercial REITs, there's REITs based off of office space and hospitals. So there's all sorts of real estate that we can look at. If we look at the specialized like AMT, it's a very well-known one. AMT today gapped down, closed down, and retested the annual low as far as a breakout. If this is going to continue, and we're going into earnings, this is going to continue, we are setting up to not only see a new low for the year. If we look at AMT going further, this is a multi-year low. AMT has already failed. It's gone from 303 and has already lost 50% of its value as prices continue to fall. If they're going to maintain their $50, $40 dividend rate, this means that they're going to struggle cash flowing. We take a look at something like CCI, and we'll look at back as well as far as the specialty. CCI gap down, closed down. Let's go back into 1 year so you can see this cleared out all the lows. And as we look at that move, that was with them beating expectations. So we are pricing in problems. If they beat expectations and gap down from 114 to 103, if they're hitting a multi-year low, here's your 3-year low again, if they've gone and reduced their price by 50% already, it does not look good for CCI. Let's go to SBAC. Go over to the daily charts. Another gap down, close down, and a new annual low. As we're looking at SBAC, we'll go back to the 3 years again. You can see that is a 3-year low. Their earnings are coming up, but if CCI has already beat expectation and fell, what's going to happen if SBAC or AMT miss? Now, these are already extended. They're already dropping. They're already seeing the impact. One of the things I want to look for are those that are maybe not at their lows and giving us an opportunity to potentially roll over and sell off. Now, Digital Realty, you can see we are at a key level. We have a gap here, a resistance here, gap up, gap down, close down. This is maybe a bearish harami with some time ahead of earnings. Now, I don't know if it's worth trading over earnings. If we see Digital Realty act like the other specialty sector, then we could see a quick drop to 102. And if we go back to test annual lows, we're talking about a 30-some% drop in price. And Digital Realty is setting up for that opportunity. Prices, as far as the options, are somewhere in the middle. You might be able to sell a call vertical up here above the highs near 122 to 125 and buy an out-of-the-money put to benefit from that move ahead of earnings. And if we see it again go back to 103 or even all the way back to 85, it could be a significant opportunity to go short. We can go look at O, Realty Income. Nice rally today despite everything else gapping down, but it's not breaking into new territory. This area is an area that has been a ceiling, and a floor all the way back through here. I would watch for this to reverse out today's price, and a move from 62 to 58 would be approaching about an 8% drop. Not as big of an opportunity, but I still like that it's in this area where it struggled to get through before. And just one more of realty specific before we get into home builders. I like the fact that CBRE is at its high and gave us a traditional reversal candle pattern ahead of earnings, and the implied volatility is relatively low. This might be one that you could do an out-of-the-money long put vertical or an out-of-the-money put, or still possibly sell a short call vertical, because you'd say, are we really going to break through the annual highs while real estate is seeing some significant slowdown? And keep in mind as well, if we're talking about 2% above the 10-year for a traditional mortgage, generally speaking, you should be looking about 2.5% to 3% for a commercial mortgage in the commercial space. So we're talking 7.5% as far as borrowing rates for companies. Now let's go take a look at home builders really quick. Home builders, if we see a slowdown in starts and a slowdown in building permits, and yes, the market was down today, but the ITB is down 2.4%. I've talked about this for weeks, that the move here, if interest rates are going to still climb, it's going to be harder and harder for them to make money. We broke through the previous channel. Today's move, gap up to start the day to a new record high, but sold off 2.5%, erasing 2 weeks worth of price. Now, do we have to sell ITB? No, but we could sell call verticals up there if you really wanted to. You could buy out of the money puts and be looking at maybe a duration put type of strategy here. But I would look at the individual companies and say, which one is going to give me the best opportunity? DHI, remember this is 30-day implied volatility here at the bottom, but we're already past earnings here. And this is with a massive win, a massive beat. They beat expectations and yet gapped up, closed down, and erased all that gain. So DR Horton is already showing some weakness. You look at Toll Brothers. Toll Brothers are down and had already rolled over and have dropped an additional 4.5%. Their earnings aren't coming up for a while, and they are responding to the rest of the market. Toll Brothers may be an opportunity to sell any bounce. Pulte Homes, not generally as strong as DR Horton. You can see that Pulte Homes is down 5%, the worst of the month so far, and selling off, likely going to continue to sell off regardless of how their earnings come out on the 25th. So these home builders have finally crested. They've reached their peak and rolling down. If home builders are slowing down, if home prices are sliding, if rates are going higher, if new home construction is slowing, if building permits are slowing, and if this is the only time that we've gone negative on case Shiller except during 2011 and 2007, this is a major indication that the wealth of the consumer and the value of the home prices and the ability to refinance the excess of debt with these high interest rates, we have finally reached that tipping point where consumers won't have the money to spend. The real estate market is slowing down, and we've seen a very close and direct correlation to broad markets and real estate. Now, going back to that case Shiller index, a couple things I want you to note. When did we go negative? Go back here, hit our case Shiller's index, look back to where we went negative, and remember this is a delayed report. It's behind, it's post 1 month. So we went negative in May of 2023. We go back here, we went negative in December of 2010, and we went negative in March of 2007. So go back to the charts. If we go back 20 years for the month, we go back and say, which month did we go negative? We went negative in March of 2007. What happened in March of 2007? March of 2007, here we were. The report comes out. This is month to month. That was the peak of the market, and it took some time. But that was the peak of the market and the beginning of the downturn. When did we base out? Look at where we based out. The lowest month, 2009, April. If we go over here, what was the lowest month? March 2009. So we saw the top of the market be established when we went negative. Doesn't mean it immediately sells off. We saw the bottom of the market happen. And remember that report would have come out the month afterward. So it really did indicate the base of the month. This was just delayed 1 month because the report's delayed a month, I should say. And then we rallied back up. Look at 2011. 2011, we went negative in December of 2010. And again, we're just going to look for the top of the market. But then we can look at the base of the market as soon as we bottom out through here. And so starting out with December of 2010. December 2010. We did something very similar to what we did here. Went flat for 1, 2, 3, 4, 5, 6 months and then dropped. December 2010. 1, 2, 3, 4, 5, 6. And then we dropped. And the drop, even though it doesn't look like much, that drop was 21% correction in equities. We did the same thing with this. The negative home price index is highly correlated to U.S. equities, is highly correlated to consumer wealth, is highly correlated to how consumers behave, purchase, and drive really growth. So this move here, the last couple of months, this is 1, 2, we may have defined the top of the markets. Today we saw a sell-off. We saw a sell-off in home prices. We saw a sell-off in home builders. We saw a sell-off in real estate specialty. And we saw a sell-off in equities. If we've reached the pinnacle, then we are possibly setting up for the top of the market that in the next 3 to 6 months, we should be looking for anywhere from a 15 to a 60% correction if home prices remain negative. That's going to do it for me. Have a great day, everybody. Look forward to talking to you again next week.